to talk about some of that with Bankim Chadha. He is the chief U.S. equity strategist from Deutsche Bank, joining me here at the stock exchange. Bankim, thanks for joining us. If anybody is optimistic on the street, it's you. 1550 is your S&P target. Why do you think most people are behind you as far as that is concerned? Most people are more bearish.
I think, the way I would put it is we think about the 1550 target, which we've had for quite some time, going back a year and a half, comes out of a simple framework of earnings times multiple. For earnings for this year, for the S&P 500, we have $99. And, to put that in perspective, I would point out that if you annualize first quarter earnings, make modest seasonal adjustment, you're already well over $95. You're at about $95.60. So $99, for 4 quarters, embodies, I would say, relatively modest growth.
And it's easy to understand that, actually. As you say, if you extrapolate from the first quarter.
Right.
But, of course, we had a slowdown in the second quarter, and Carol and Mike just talking about the jobs picture. It is not rosy, as you know. It looks like we're seeing a slowdown in general for this recovery. So doesn't that put a question mark on the $99 estimate?
I think that earnings have actually been very, very resilient. Keep in mind that basically S&P 500 top line typically grows much, much higher than nominal GDP growth grows in a typical recovery. So, S&P 500 sales growing 4 or 5 to 6 percentage points higher than nominal GDP for 3 or 4 years is actually typical in a recovery. And if you do the same exercise by sector, I think you're going to find 7 to 8 out of the 10 sectors have top line growth that exceeds nominal GDP growth right now. So, I think earnings season will be interesting. The bottom-up consensus does have, for the first time in 2 years, a sequential increase in earnings. We think that there's pretty big differences in the blocks of sectors across the global cyclicals, across the domestic cyclicals, where the bottom-up consensus is essentially factoring in recession-type growth.
What are the biggest differences? What are the biggest differences? Where are you seeing the biggest as the biggest winners and the biggest losers?
So we think the domestic cyclicals, which would be the financials, industrials, tech, and consumer discretionary, as a group, estimates have been cut way too much. Energy and materials, estimates went up with oil and commodity prices, but didn't really come down, so they're most at risk. I think on the defensive sectors, the estimates seem okay or in line, basically.
Hey, Bankim and Matt, I want to bring some of our market guys into this because both Adam and Sheila have been looking at earnings. Adam, let me bring you in first because analysts have been steadily raising their estimates when it comes to earnings as we head into the season here.
Yeah, they have. If you go back over the past couple of months, Carol, let me show you the numbers. The estimate for the S&P 500 earnings were about 94.26. That was back in May. In June, it went up into the 95s, and now, of course, it's $96. So the question is, Bankim, if guys are upping their numbers, but they're not keeping pace with you, what exactly is going on here? Why are people willing to give a little bit of the benefit of the doubt, but not quite follow through to the extent that you are?
So I would say if you take a closer look at the bottom-up consensus in terms of earnings, to point out again, we've had 9 quarters of solid beats, between 6 and 10% per quarter. And the response of the bottom-up consensus has essentially been to market the current quarter, and in so doing, basically lower forward growth rates. And that's actually allowed basically earnings as they've come in to keep beating, because typically when earnings surprise in level terms by a big amount, there's no intrinsic reason basically to change or lower the forward growth rate. But that's exactly how the bottom-up consensus has treated earnings. Earnings estimates don't really look high at all in the current quarter, where we're going to start getting reports next week. Basically, as I said, there are big differences between the global cyclicals, so energy and materials, which went up with oil and commodity prices, but haven't really come down as those prices corrected. And for the domestic cyclicals, earnings estimates have continued basically to be cut, and I would put and characterize current estimates for the quarter at essentially recession levels. So very, very low.
Bankim, I do wonder about some issues that have been out here during this last earnings quarter. And Sheila, you've been looking at kind of some of the bigger fundamental issues that might be impacting earnings here.
Yeah, Binky, you've brought up your earnings estimates to $99 a share for the S&P for the year. My question to you is, we've had so many one-off situations happen in the past couple of quarters. You think about what's happened in Japan. You think about those extraordinary high oil prices. Both effects of that seem to be reversing now. We do see a lot of tech companies coming out saying more positive things in the aftermath of the Japanese earthquake, etc. My question to you is, how much is your call just a reversal of some of these bigger effects, or how much of it is just a fundamental people are actually starting to buy things again from these companies?
So a whole set of questions there. I mean, in terms of the shocks, clearly we see the impacts of the Japan earthquake and that feeding through, for example, to the auto sector as largely temporary. So if there is some payback, and there will be some payback, and as I mentioned, basically, estimates for the consumer discretionary sectors have basically been cut down to recession levels, and you're going to get payback in the third quarter. So that should not really have an impact, basically, for the year as a whole. I'm sorry if I didn't answer all those questions.
What about,
there.
I'm interested in your call on financials, because it's been a controversial call the last couple of weeks. It was hated here in the markets for a couple of weeks, and last week with the big rally, you had a lot of more contrarian hedge fund managers, but big players come out and say, hey, we hold, 25%, 30% financials. Why do you like them here with all of the threats, with the deal that Bank of America just did, $8.5 billion, with the possible increase in Basel capital requirements for the systemically important financial institutions? There's so many headwinds.
I mean, from a strategy and a portfolio management point of view, I mean, the simple point that I would make is it's always a function of what's in the price. I mean, keep in mind that at the beginning of the year, the view and sentiment regarding healthcare was very, very negative, and then there was a pretty sustained, pretty long period there for which healthcare was the best performing sector. So we take the same view really on the financials, and if you look at the relative performance of financials, or the way that we do it as a pair trade is the financials versus consumer staples, hasn't really budged over the last 4 to 6 weeks. So I'm not really too concerned about my call on the financials. There's a number of things that suggest that the bad news is basically in the price. If I look
but
at
growth isn't there, right? I mean, net interest margins are low. Loan growth, loan demand isn't out there, even though we keep waiting for it to come back. The consumer still has to deleverage.
Sure. So on the loans growth, which is absolutely key, I would argue that if you look across the categories, as is typical basically in recoveries, you're already seeing certain segments start to turn around. So if I look at C&I loans, that growth has already turned positive. So, if I look at consumer lending, I look at banks' willingness to lend to consumers, that leads by about 4 quarters. So that's telling you that loans growth to consumers will pick up. Now, I think if you wait to buy or to be fully allocated to the financials, once those things turn around, you're going to miss a chunk, basically, of the returns. And we could debate how much that is. I prefer to be fully allocated and slightly overweight, given what's happened.
So, Binky, we've said you're the most bullish guy out there. You're looking for now, about a 16% rise on the S&P by the end of the year. So what area of the market, though, do you not like? Is there any area that you're staying away from at this point?
So basically, I mean, what we have is classic textbook style, given our view that it is the macro drivers combined with earnings that will basically result in our baseline view of what, I would term a snapback market, very much like we saw last fall, but really happening earlier. If I look at the macro data, my macro data surprise index, looks to have bottomed, has started to move up. At this stage, I would characterize that as really, less bad data, but the view on the fundamental basis is that, things will turn around, the data will improve, and so the data surprise index, has started to turn, but it's still, towards the bottom, and so it's got a long ways to go, and that should take basically the cyclical sectors up at the expense, really, of the defensive sectors, which have massively outperformed over the last, 3.5 months.
Got it. Binky, thanks so much for joining us. Binkim Chadha from Deutsche Bank.